If you are a server or a bartender, you really need to get with your lender, I would say close to a year in advance. If you're only claiming that you're making minimum wage, but really you're making 50, 60K a year, but we have to qualify you off $7.25 an hour.
Welcome to the Real Pulse of Real Estate, where we discuss the true ins and outs of the housing market. Welcome back to episode 3 of Real Pulse of Real Estate here in Northern Kentucky. I am Adam Cron, being joined by David Behymer once again. Hello, David.
Hello, thanks for having me.
This episode, I kind of want to go ahead and go into, we've talked interest rates, we've talked why you've been in the business, we've talked a couple of things over these last few episodes. Debt to income ratio.
The big one.
What on earth does it mean? Why does it have so much effect on buying power to clients and fail or pass for getting pre-approved?
So basically your debt to income ratio is essentially just saying, based on your income and what debts you have, can you afford this mortgage payment is the easiest way to just say it.
Okay.
For instance, there are two different debt to income ratios. There's your front end, which is considered what's called your housing expense ratio. Mm-hmm. And then there's your back end, which is basically your total ratio. Oh, you know me, I have my little math again. Mm-hmm. Disclaimer, I went to public school in Campbell County, in Northern Kentucky, Campbell County. So bear with me. So basically I just did some quick math here. So if somebody makes $5,000 a month, and we're talking gross income, so everything, we always go off of gross income. If somebody makes $5,000 a month, to try and figure out, kind of what kind of monthly payment can I afford is I'll take that 5,000, I'll multiply it by 0.49, which is 49%, which is typically the max back end debt to income ratio you can have for a conventional loan. Now, if you have lower credit or things like that, then sometimes, Fannie Mae and Freddie Mac want to see that back end number come down a little, but just for number's sake,
just across the board average, right?
Yeah. So we'll say 49%, that equals $2,450. That is technically what mortgage payment you could afford if you have no other debts. Now, Who has no other debts, So I wanted to get a little more realistic with it. So I just added a couple of little things in here. So, $2,450, let's say you have a $400 a month car payment and you have two credit cards. One has a $30 monthly payment. One has a $20 monthly payment. So all in all, it drops down to where basically what you can afford for principal, interest, taxes, insurance. Then if you have PMI, if you have HOAs, anything altogether, you can afford roughly $2,000 a month total mortgage payment.
So really quick, when you say total mortgage payment, is that including taxes and insurance for escrow? Okay.
Yes. So that is your principal, that's your interest, your taxes, your insurance, and association, HOA. So that's your PITIA payment, which is all inclusive.
Very fancy.
Yes, exactly. So if you hear people saying PITIA, PITI, that's principal, interest, taxes, insurance, association fees.
Gotcha.
So all in all, you'd be at that, which then, if you take that 2,000 divided by 5,000, that's 40%, which would be your front end debt to income ratio.
Gotcha.
So what kind of goes into your debt to income ratio? It's not the fact that you have a $50 a month phone bill or you pay, $20 a month in water or electric. It's only the things that show up on your actual credit report. So what are your actual debts? And that's the other thing too, is that, obviously if you're paying utility bills, well, if you're buying this house, you're not living in that house. You're not going to pay electric. So why would we count that against you? So really it's only like your actual liabilities that you're responsible for on your credit report. That's what we're counting against it. Now, what I will say is that where it can kind of get into those little gray areas is, let's say, what is it? The Snap-on tools. That's kind of a weird one where they don't necessarily go on your credit report.
Yeah, okay.
Because
but there are monthly payments, right?
Yes, they are monthly payments you are liable for. So that's something that we've come into where sometimes on the bank statement, I'll see that you have a $50 biweekly payment going to Charles at Snap-on. What is that? It's, I owe this guy money on Snap-on. Well, that's considered an undisclosed debt. And we do have to count that because, again, it kind of all goes back to, trying to do everything we can to not have 2008, the sequel happen. Yes. We want to make sure, that back then you could go in, hey, I want to buy this $500,000 house. Okay, here, sign this application. And it's, do you want to buy this house? Yes or no, almost. Yeah. Like it was, there really wasn't the hoops we have to jump through when it comes to asset and income verification. So that's where, a lot of people think that we're just being mean. We don't want you to buy this house. No, I've had people get frustrated and yell at me on the phone and they're like, David, I'm sorry. Like, I'm not trying to take this out on you. And I go, no, it's like, I don't take offense by it because My job's black and white.
Mhm.
It's,
Yeah.
can you afford this based on what I'm seeing with the numbers? You shouldn't bend them for most cases, but there are things where there are certain guidelines, like Fannie Mae and Freddie Mac have guidelines where if somebody gets Social Security income, if their debt to income's tight, you can actually gross up to Social Security income, what is non-taxed, by 25%. That can be a game changer for a lot of people who may be just above or right at that debt to income threshold. Well, now if we can gross up that, we find out that, your $1,000 a month Social Security can get grossed up by 25%. Well, now instead of making $1,000 a month, you're making $1,250. Like, that eats that car payment right there.
And that's one big thing of, it's still something that's coming in consistently. It's not like a commission, right?
Yes.
Where it's like, we don't really know if it's going to come in or not. It's still providing of a guaranteed these numbers are coming in. Because
Yes.
I do think that's one big thing that, especially in this current market, not a lot of people are comprehending is the difference between 2008 and everything else, because of the certain recessions we've gone through and the amount of recessions we've gone through. So many people remember 2008 because it was so drastic and so aggressive. And yet in multiple recessions before and after, housing prices have continued to go up.
Oh, yeah.
Not by the 12% or aggressive numbers we saw in 2020 and 2021. Right. However, they still trend upwards for the most part. Now, there are numbers where they've gone down and it hasn't been the aggressive like 19, 20% that they did in 2008.
Yes.
However, like what you're talking about, the numbers you guys are looking at and the frustration you do get from clients, I tell people all the time when they're getting pre-approved, understand they're going to be asking you a lot of questions. You're going to feel almost like a felon, essentially, of like, are they trying to catch me doing something illegal?
Yeah.
Truly, because one, it's not you just doing it for fun.
Right.
It's a federal thing.
Yes.
This is across the board. In order to protect from what happened, this is now what we're doing.
Yes.
You might get asked of, hey, can I have this bank statement? And you're like, I swear I sent them that bank statement. You probably did. They're asking you for it again just to prove, one, that it's updated, and to prove that it was actually yours and not falsified.
Yes.
Things like that.
Oh, and that's the other thing I've noticed with people is that I'll say, hey, I need your bank statement. I need all pages. Well, page 5 and 6 is where it stops. 6 of 6 just says it's intentionally left blank. Yeah, I know, but I still need to see it. And it seems so dumb, but it's just one of those things where we just have to make sure that all bases are covered, just to make sure that there isn't any weird thing that on page 6 of 6, it's, oh, by the way, he also has a home equity line of credit that is this, or, he's financing his car through the same bank that he banks with. And this is, we actually don't put it on his credit report because we just withdraw straight out of his, and I'm sure that's not really a common thing by any means, but it's it's something that we have to exert all options. And mostly the fact that when we're doing it up front, it's mostly to protect the people from the deal falling apart, because yes, I could take your word for it and give you a pre-qual letter instead of a pre-approval letter.
Yeah.
I could say, oh, yep, John Smith, you make $100K a year and you have no debt and you have $1 million in the bank. Sweet. But then when I need to see the bank statements and I need to see the pay, if, oh, well, you told me you make 100, you actually only make 50. Too many people don't really lie on their applications. I'd say it's more of where it comes into play is when you have like self-employed borrowers or commission borrowers.
Yes.
We need an average of 2 years. And one of the things is that with self-employed borrowers, one of the biggest perks is writing stuff off. So I had a borrower last year who he was pre-approved with an unnamed online lender. I'll just say that.
Okay.
Air quotes.
Got it.
He was got a pre-approval letter, got under contract. Started really not liking the service, was like, yeah, you know what? I think I want to go with somebody else. This just, I'm not really, I need somebody more in tune. I need a local guy that I can talk to.
Knows
like
the
that.
area, knows how to pronounce.
Exactly.
I've had online lenders call it Wilder, Kentucky instead of Wilder, Kentucky,
Hilarious.
that kind of stuff.
So he calls me and he's like, hey, I'm self-employed. I make $300-400K a year, great income. And I'm like, wow, this all sounds great. I need your tax returns. I need your business bank statements. I need to see, what you're actually, if this is accurate. Oh, okay. Well, hey, actually on my tax return, it'll show that I had a loss 2 years ago. And then this year I only made technically 25,000.
Yep.
And I'm looking at it.
The tune.
Yeah. And then I'm like, okay, well then now technically we have to go this. I mean, it's 25,000 divided by 24. So now basically you made almost 13,000 a year trying to buy a $400,000 or $500,000 house. And it's like, yes, on paper you make this amazing money, but
taxes wise, you made less than minimum
wage.
What
Uncle Sam's counting is this. So that's where, I always try to educate people ahead of time if they have like, servers in the family, bartenders, things like that. I try to tell people like, if you are a server or a bartender, you really need to get with your lender. I would say close to a year in advance of you wanting to buy a
Prepare
house.
yourself.
Prepare, prepare, because the same thing. One of the biggest perks of being in the restaurant industry, you obviously claim what you need to claim and you pocket the rest. I get it. I used to work in the restaurant industry, but where that hurts you is that if you're only claiming that you're making minimum wage, but really you're making 50, 60K a year, well, we have to qualify you off $7.25 an hour.
Yeah.
That's where it comes into place. That's where I tell people, if you're looking a year or two in advance, for those 2 years, I know it'll suck that you're paying these extra taxes. Claim everything. Yeah. Claim everything you can. So that way, when I get the 2-year average of your tips income, it'll show what the actual story is. And then I can actually qualify you based on what your actual income is. But if you claim that you're not making that much, well, then that's what I have to go off of.
Let's talk a little bit and jump back just a short bit of pre-qual versus pre-approval.
Yes.
I mean, I feel like there are so many buyers that I end up talking to that they hear the word pre, don't listen to the rest of it, don't understand what the difference is, and don't understand the severity of the others, right? Because there are lenders that they'll pre-qual and there are lenders that will pre-approve.
Yes.
They're very different things. People just don't understand it because they think, okay, that's my buying power. Here's a letter saying I'm pre-qualled or I'm pre-approved. What's really the difference? Can we dive into that a little bit?
Absolutely. One thing I will say is that there are lenders that will call a pre-qual a pre-approval.
Yeah, and I think that's where a lot of the translation gets.
That's a big thing.
Yeah.
That's something that a lot of people do. I don't like doing that just because at the end of the day, I don't like deals blowing up. I like my referral partners to get paid. I like my clients to get a house. So,
and as you've mentioned yourself with guaranteed rate, you have 100% close rate with everyone you've pre-approved.
Exactly. So, and that's what we take that very serious because not even just from the standpoint of, oh, cool. Yeah, we're closing, this much volume or whatever. We truthfully as a team, we don't even look at our volume of loan amount numbers that we're selling. We look at the units sold because that means that's how many families we get to help. So that's why we take that very serious. So the difference between a pre-qual versus a pre-approval, pre-qual is essentially you fill out your application. You say, I make $6,000 a month. I have 40 grand in the bank.
Yeah.
And I say, wow, this is great. And then, maybe your credit's an 800. So I look at it and I just say, I'm going to take your word for it. I say, okay, yep, here's a pre-approval letter is what I say.
Yeah.
Well, then let's say this person gets under contract. Well, now they're under contract and I say, okay, hey, now I need your pay stubs. Now I need your W-2s. I need your bank statements. Oh, okay. Well, hey, I actually had some bills come up. I only have 4,000 in my bank. And I think I accidentally grossed up my, quote unquote, accidentally grossed up my income. I actually really only make like 35 to 4,000 a month. And it's like, okay, well, that changes everything because if your debt to income was tight, or maybe now you don't have the cash to close and you got by without asking for seller credits or you're not doing down payment assistance, there's those things that now you don't have the money to pay for this house. You don't have the money to buy this house. That's everything just fell apart right there just because. And, at the end of the day, it could be, oh, well, they didn't tell me the true story. But at the end of the day, it really is on us as LOs to get that full scope to say, this is vetted, this is good. So a pre-approval is a vetted, I've seen your bank statements, I've seen your pay stubs, I've seen your W-2s. I have vetted this all. And then one thing that we do at Guaranteed Rate to take it a step further is we actually have what's called power bid pre-approval, where I take all those documents. And what I try to do is, if I have the documents and I can give a pre-approval, I like to send out the pre-approval. Then what I tell my clients is I say, hey, while you're shopping, I'm going to go ahead and send your file into underwriting early.
Yeah.
So that way what they do is they then give me their blessing. So then underwriting's done. Basically, you take all the documents that they already gave me. I upload it into their file. Underwriters vet it all. They say, hey, I have questions about XYZ, or hey, no, you're good to go. If they say they're good to go, I can actually update their pre-approval letter with my fancy, you've seen the 21-day guaranteed clear to close, where we can get it all knocked out in 21 days guaranteed, even with the appraisal, because all we're waiting on at this point is the title work and appraisal to come back. Because once that file has been underwritten by that underwriter, they pick it up when you're under contract, and it's the same one who's already
seen it prior.
Yeah, they're aware of this file. They know what's going on, and they basically just relook and say, oh, okay, yeah, these updated pay stubs are still good. These updated bank statements, they still get paid the same. They still had the same amount of money. Yeah, this person's good to go. And it just kind of speeds everything up. So that's the difference. Is a pre-qual is I'm taking your word for it. A pre-approval is you're vetted.
Yeah, and I think that's one big thing that is just really important to understand, especially with the documents that you do up front. You're not doing it just for fun. You're not doing it just to cause more issues, right? Because there are those frustrations of like, oh man, like I have to get all this stuff before I even buy the house. I fully understand, but at the end of the day, it's there to protect the client. It's there to protect and make sure that they feel comfortable with the numbers they have and they actually have the numbers they're talking about.
Yes.
And truly, I don't think people understand to what extent the loan officer can make the difference, the title company can make the difference, the realtor can make the difference.
Oh, yeah.
There are times I have gone with guaranteed rate pre-approval letters with your name, with Ravi's name and everything, stating this is who I have. I've gotten the offer accepted at a lower price point than another offer because of who their pre-approval is with.
Oh,
because
absolutely.
they're known for, they really only have a 50% close. If we have to contact somebody, we're going to get a machine,
Yeah.
right? It's not a direct, hey, I can call this person at 9:00 at night and get it resolved sort of thing. They're not coming to me with solutions when there was a problem and I didn't even have to worry about the problem,
Right.
things like that. So I do think it's more fun to just say, oh yeah, I'm pre-approved of this and I'll take care of all the documents later. Absolutely.
Oh,
At the
yeah.
end of the day, I would love to be the Oprah of real estate and you would love to be the Oprah of real estate of let's get you in a house. Let's get you here. Let's
get a house.
But that's what 2008 was. And that's
Yes.
what we're no longer doing. And that's why we're trying our best to absolutely protect clients at the end of the day.
Yes.
It feels more punishing in a sense, just because of all the work you have to do up front.
Oh, yeah.
But it's so vital and it's just so important to make sure it's done properly.
Well, and what I tell people is that you give me this stuff up front. Yeah, I may need to ask for an extra pay stub or a couple extra pay stubs by the time you get under contract. I may have to ask for a new bank statement. Underwriters, after they finally take their final review, they may say, oh, hey, I did, I overlooked this. I do need a clarification on this. But like, you get me this stuff up front, it's just going to make it easier on you down the road. And my whole thing is that, would you rather be stressed to get me documents when you're already stressed about inspections, appraisals, getting under contract? What are the next steps? Do you want to stress about getting me pay stubs and documents then? Or do you want to get it when you're not under contract? And then when you're under contract, you're like, oh, David's just asking me for a letter of explanation on what this address is. Oh, well, that's my parents' address that popped up on my credit report. I used to live there. And then they just write me a letter and then that's all they got to get me. Like I would rather you, when the stress of, okay, things are actually moving is going on, that's when I don't want you to have to worry about, hey, yeah, now I need your W-2. Now I need your bank statement. Now I need this. Now I don't want to do that. I would rather get it up front and make it just a smooth experience all the way through from start to finish.
Yeah. All while I'm trying to say, okay, inspection report is in. And here's what we should go through. And here's what I need you to sign repair addendum wise and all that.
Exactly. I don't want them getting hit on all angles. I'd rather hit them up front and then let you do your side once they're under contract. And then I'm just asking for a couple things.
Awesome. Well, David, I appreciate you being on again,
of course,
and explaining debt to income ratio this time. So always a pleasure, sir. If people are wanting to find out more information about you or look you up, how do they do so?
Yeah, so you can always find me on Instagram, LinkedIn, Facebook, TikTok. I'm under just at Loan Officer Dave or David Behymer at Guaranteed Rate. And then you can always find me on my website at www.rate.com/David Behymer, Behymmer.
Awesome, sir. Well, thank you so much for being on.
As always, thanks for having me.
Thank you to everyone listening to Real Pulse of Real Estate. It's been an absolute pleasure. We're hoping this is just great snippets to bring you on a weekly basis to just understand more about the process of real estate. So if you can go ahead and like, subscribe on whatever platform we're on, I'd appreciate it. And looking forward to having another episode. Thanks for joining us for this episode of Real Pulse of Real Estate. If you're looking for more content, follow me on Instagram or TikTok at I'm Cron Burgundy or Facebook at Adam Cron Realtor. Can't wait for you to join us next week.